Single entry system. So just a bit of a background. Um, in our basic accounting, we were taught how to journalize. That's one debit and one credit. For every transaction, there should be at least one debit and one credit. So for each transaction, there are two accounts which are affected. So this is what we call a double entry system. Double entry system was adopted from the book of Lucas Pacioli called Summa de Arithmetica Geometria Proportioni e Proportionalita, or its summary of arithmetic geometry, proportions, and proportionality. So what is single entry system? Single entry system is a system of record keeping in which transactions are not analyzed and recorded in the double entry framework. It is where the records are considered incomplete. So most of the time, the proprietor normally maintains a cash book which records all cash receipts and cash disbursements. You have a list of open accounts, customers with open accounts with balances, and a list of payables to certain suppliers. Sometimes the entity also maintains a record of assets which have been acquired. Most likely, it refers to fixed assets. Now, single entry is more or less the same with cash and accrual. That's why knowledge or the methods used in cash versus accrual basis of accounting is more or less um, can be applied in the single entry problems. So common problems about single entry normally involve determination of income, preparation of income statement, and preparation of balance sheet. So particularly for the last two, um, most of the time, since you have an incomplete record and you're required to file financial statements at the end of the year, you're made to prepare income statement and balance sheet out of the incomplete records. So for purposes of this problem solving, it's important that you revisit your learnings concerning the capital account and the retained earnings account, particularly the components of those accounts. Better yet, the statement of changes in owner's equity and the statement of retained earnings. For the practice problems, we will limit ourselves with four problems, the common problems due to limitation of time provided in Facebook, or I'm sorry, in YouTube. So we have problem number one, Sile Company. Sile Company started his business some years ago. As of the beginning of the year, the capital account of Sile Company had 1 million balance. During the current year, he made additional investments amounting to 300,000. His total assets increased by 2 million. Its year-end liability last year was 650,000. At the end of the current year, Sile made a withdrawal amounting to 150,000 and its liability doubled from the beginning of the year. Question is, how much was the income or loss during the year? So the T account that we will use would be the capital account. So we write the beginning and ending balances. In the problem, however, what's given is only the beginning balance of 1 million. And then the ending balance is not given. Additional information you have is the additional investment made amounting to 300,000 and the withdrawal at the end of the year amounting to 150,000. So before we can determine the income or loss, we should determine first the ending balance of the capital account. And we can do that by referring to the other T accounts, assets and liabilities. So remember the accounting equation, you have asset is equal to liabilities plus capital. So for total asset, the only information mentioned was that there was an increase from 0 to 2 million. There's an increase of 2 million. Increase of 2 million. For liabilities, you have the year-end liability last year, which is now your beginning balance of liability, 650,000. And then, as of the end of the year, your liability doubled. So that's 1,300,000. 650,000 times 2. So basing on the accounting equation, asset is equal to liability plus capital. The beginning balance of 650,000 and the beginning balance of capital of 1 million, that will give us a beginning balance of asset amounting to 1,650,000. And because there's an increase of 2 million for assets, that would mean the ending balance is now at 3,650,000. So 1,650,000 plus 2 million, you have 3,650,000. So from there, we can now determine the ending balance of capital. So 3,650,000 minus 1.3 million, this would be 2,350,000. 2,350,000. So now that we have a beginning and ending balances and other elements of the capital account, we can now determine the income or loss. So the total debit is 2,350,000 plus 150,000. That's 2,500,000. Total credits is only 1.3 million. So we have a credit balance. So to get the difference, 2,500,000 minus 1.3 million, you get 1.2 million. Since it's on the credit side, this represents your net income. Problem number 2, Daniel Company. Daniel Company started his business at the beginning of the year. He maintains incomplete records. He started with a cash investment of 1 million. The entity used the cash investment to buy some machineries to manufacture its product and the service vehicle to deliver its product. Its remaining cash was used to buy supplies and to fund the working capital. During the year, the entity earned 500,000 through cash sales and sales on account. Further, it incurred expenses, including interest expense, amounting to 345,000. The proprietor used 150,000 worth of merchandise from the entity for its own consumption, and further to expand its business, the entity obtained a loan from Banco de Bancroft amounting to 750,000, half of which was paid off by the entity at the end of the year. How much total assets should be reported by Daniel Company at the end of the year? So again, we go back to our basic accounting equation. You have assets equal to liabilities plus capital. So we don't have any information as to the beginning to the ending balance of assets. What we do know is that its beginning balance is 0. Okay. We don't know what's the ending balance. However, we can determine for liabilities and capital. For liabilities, according to the given, so there were, since it started on the current year, 0 beginning balance, and then it obtained a loan amounting to 750,000. But he was able to pay half of it before the year ended. So 375,000, your liability has an ending balance of 375,000. So all we need to do is to get the ending balance of capital, and we can now determine the ending balance of asset. So for capital, you have 1 million cash investment. And then, during the year, the entity earned 500,000 and incurred expenses amounting to 345,000. That would mean the entity earned a net income of 155,000. And then, the proprietor used 150,000 worth of merchandise for its own consumption. That would mean it's a withdrawal of merchandise. That's a debit of
150,000. So the ending balance, you have 1 million plus 155,000 plus 150 minus 150,000. You have an ending balance amounting to 1,005,000. Going back to our accounting equation, liabilities of 375,000 plus capital of 1,005,000, we get a total assets of 1,380,000. So that's 1,380,000. Then we have problem number 3. So the following increases or decreases of account balances were taken from the incomplete records of Cresia Corporation. So you have accounts with corresponding increases and decreases evidenced by positive and negative signs. During the year, the entity issued additional 1,000 shares at par value for 100 pesos each. The entity later declared a 25 dividend for each share withheld. So this type of problem is actually common for single entry. You're given with accounts with corresponding increases and decreases. In order to answer this type of problem, first we need to get the relation between assets, liabilities, and capital. So first for asset and capital. If an asset increased, that would mean capital also increases, evidenced by your accounting equation. They are both positive. So if this one increases, this will also increase. If this asset decreases, then your capital also decreases. Now here comes liability. Okay? If you're going to transpose liability on the opposite side of the equation, that would become negative. Okay? Negative. That would mean the relationship between liability and capital is what we call inverse. Asset and capital is direct. Liability and capital is inverse. That would mean if there's an increase in liability, there would be a corresponding decrease in capital. If there's a decrease in liability, there will be a corresponding increase in capital. So we're going to apply that knowledge in answering this problem. Okay. So we have a cash increase of 500,000, meaning our capital increased by 500,000. That's a plus. Notes receivable decrease. So there's a decrease in assets since there's direct relationship. That's negative 100,000. Decrease in capital at the same time. Inventories increased by 300,000. Inventory is an asset. Then there's your direct relationship, so you add 300,000. PPE increased by 200,000, so add 200,000. Accounts payable decreased by 200,000 because of the inverse relationship between a liability and capital. This decrease in accounts payable means an increase in capital, so plus 200,000. And the notes payable increased 300,000. Again, there's inverse relationship. So this increase in notes payable means decrease in 300,000. So the net increase or decrease in net assets would be 500,000 minus 100,000 plus 300,000 plus 200,000 plus 200,000 minus 300,000. That would be 800,000. Net increase of 800,000. So if this is your capital account or your net assets to be net asset or capital account, to show that there's an increase, you can start with 0 and then 800,000. You can actually use any figures as long as the increase is 800,000. So you can have 1 and 800,000 in 1, or 100,000 and 900,000, as long as the difference between the beginning and ending balance is 800,000. And then you add on additional information. So during the year, the entity issued additional 1,000 shares at par value for 100 pesos each. That would mean the net asset T account, has increased by 100 times 1,000. It's That's 100,000. At the same time, there were dividends declared, 25 pesos for each shares outstanding. So that's 25,000 on the debit side. So you can now get your net income or loss. So the total debit adds up to 825,000. Well, in the credit side, you only have 100,000. That means you have a credit balance of 725,000, which is your net income for the year. Now, to show you that you can actually use any other figures as long as the difference between beginning and ending balance is 800,000. Let's just say your beginning balance is 100,000. And then because of an increase of 800,000, your ending balance would become 900,000. So you have 100,000, additional 100,000 for the additional shares issued, dividends 25,000. Your total debits would now add up to 925,000. Less 200,000 on the credit side, you will still arrive at the same answer, 725,000. So the important thing you have to take note in this kind of problem is that sometimes in a problem they will also provide the increase or decrease of a capital component. For example, increase in ordinary share capital or increase in share premium. Take note, you do not apply it the same way as asset and liabilities. What you're going to do with that type of problem is that you reflect that increase or decrease in share capital or share premium here in the net asset or capital T account. So you have there certain problems in the book. You can use that to practice. Then we have the last problem, problem number 4. The following increases and decreases were taken from Lifewealth Corporation's incomplete accounting records. You have assets, 800,000 decrease, liabilities, 500,000 decrease, increase in share capital, and increase in share premium. There were no other share capital transactions other than the declaration of dividends amounting to 700,000. Question is, how much was the net income or net loss for the current year? So, same as before, you take the relationship between assets and capital or net assets and liabilities and net assets. So decrease in asset of 800,000, decrease because there's a direct relationship between assets and capital. This means that's a negative 800,000. Liabilities decrease of 500,000 because of the inverse relationship, that would mean plus 500,000. Then you have an increase of share capital and share premium. As I have mentioned before, if you have an increase or decrease of a share capital component or a capital component, you don't apply it this way. You will reflect that change in the T account. So we'll stop here first. So there's a net decrease of your net assets of 300,000. To make it easier, capital account, we can start with 300,000 as beginning balance and 0. So if you'll notice, there's a decrease of 300,000 from 300,000 beginning to 0 at the end. Again, as I have said before, you can use any other figures as long as the difference between the beginning and ending balance is 300,000. And then to apply what I said earlier, capital transactions or capital components, increases or decreases of the capital component shall be reflected here in the T account and not like this. So you have share capital of 1 million increase, it's a credit because that's an increase, and share premium of 500,000. Then there's your dividend declaration amounting to 700,000. That's all there is. So you get the total debits and credits. For total debits, that would be 700,000. Total credit is 1,800,000. Okay, that would mean you get the difference. You have a debit balance amounting to 1,100,000. Because that's a debit balance, that means that's a net loss. So again, as I've said, If there are given in the problem showing increases or decreases in a share capital account or a component of a capital account, you do not do it the same way as assets and liabilities. You reflect it in the T account for the net assets or capital.